Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to quickly go over the latest earnings report of Granite REIT. I think I'm the only one, or at least one of the few people on the internet, and especially YouTube, that talks about this Canadian REIT. And in my opinion, Granite is one of those hidden gems in Canadian market. I personally own Granite REIT in my stocks portfolio as my largest REIT holding. I believe they reported absolutely amazing numbers in the recent earnings report. And if the market in general was not going through a difficult time, through a significant downturn, we could see that Granite stock price goes up by at least 5% today, in my opinion, after this stellar earnings report. For those of you who are not familiar with this company, Granite is a Canadian real estate company which can give you exposure to physical properties in the areas of logistics and industrial warehouses in North America and Europe. They have already a diversified portfolio of various industrial and logistical properties in 6 countries around the world, including Canada, US, Netherlands, Germany, Austria, and Czech Republic. The largest tenant of Granite is Magna, followed by Amazon. And we can see very established businesses like Samsung, Walmart, and Wayfair among their tenants. They actually aggressively trying to diversify their tenants and reduce their exposure to Magna every single quarter. For example, last year, their exposure to Magna as a percentage of their total revenue was 29%, while this year it is only 26%. The growth of e-commerce businesses, fulfillment centers, and the need for industrial warehouses all caused Granite business to boom in the past few years. But a lot of people and a lot of analysts expected that this company will have major headwinds moving forward in a high interest rate environment where potentially the e-commerce businesses will go through a rough time and when the economy is heading towards a recession. However, the recent earnings report of Granite is painting a completely different picture, and I am happy to be a shareholder of this company. In this video, I will break down the earnings of this REIT. If you want to see how to evaluate a REIT, watch my previous video on basically REIT indicators, which I will leave a link to that video in the description box below. Okay, now let's look at the key numbers. The most important metric, adjusted funds from operation or AFFO, was $1.05 per unit for Q4 2022 versus 90 cents per unit in Q4 2021. This is a 16% increase year over year, which is absolutely amazing number for a REIT. For the whole year of 2022, AFFO per share was $4.05 per unit versus $3.75 per unit in 2021. This is an 8% increase year over year. This REIT is growing pretty fast. For your reference, the average AFFO per share growth rate for REITs is usually close to 2% year over year. So Granite is growing their AFFO almost 4 times faster than the average REITs in the market. As a result, their adjusted funds from operation payout ratio was 75% for the fourth quarter of 2022 compared to 84% in the fourth quarter of 2021. Their payout ratio is very conservative at 75% of adjusted FFO, which means they have 25% of their FFO for developing new properties and potentially reinvesting themselves to buy and acquire new warehouses. We should also expect a distribution hike in the next few quarters as they have lots of room here in their basic adjusted funds from operation. If we look at the historical performance of the company, we can see an impressive consistent growth history in total revenue and adjusted funds from operation, especially during the last 5 years. And at the same time, we can see a growth in the distribution or dividend of the company. The reason so many REITs in Canada cannot grow their dividend or distribution is simply the fact that they cannot grow their adjusted funds from operation per share. Some of them cannot grow this at all. For example, this is the adjusted funds from operation per share of another Canadian REIT, Northwest Healthcare REIT, which you can see here, this is totally flat in the last 5 years. And they could not grow their dividend in the last 5 years because of this flat adjusted FFO. With Granite, we have a consistent growth in adjusted FFO and as a result, a consistent increase in the dividend or distribution of this company. Let's continue to look at the earnings report of Granite as it gets actually better. Same property net operating income, which is another important metric for a REIT, is also increased by 6% in this quarter, excluding the impact of foreign exchange, of course. This basically shows that Granite was able to increase their profit on their existing warehouses, basically without the need to build or acquire new properties. Basically, their existing buildings were able to generate more operating income due to higher rents organically. This is very important for a REIT. One of the shocking things that I saw in this report was the fact that they bought back shares in the last quarter when the share price dropped below $70. Real estate companies or REITs usually only dilute shareholders to raise capital, and it is totally normal. If you look at the share count of most of the REITs, you can see that the chart is only going up over time, and they issue more and more and more shares to raise capital and buy new properties. And we usually never see a REIT buy back its units. But Granite repurchased basically almost 1 million stapled units at an average stapled unit cost of $67.60 for total consideration of almost $70 million in the last quarter. This is great. It's not that much, but it's great. It means the management team at Granite are serious about returning value to shareholders, so they buy back the shares when it is undervalued. I really like the capital allocation of management team at Granite. They know exactly where to deploy their capital and how to grow value and return the value to the shareholders. Not only that, but also Granite has one of the lowest levels of debt between all of the Canadian REITs, as demonstrated in this plot in their earnings report. The total debt to capital ratio is around 30%, while the average debt to capital ratio for Canadian REITs is around 42%. And their debt to EBITDA is around 8x, which is again lower than the average for a Canadian REIT. Overall, they have amazing adjusted funds from operation growth rate. They have very conservative payout ratios. Their debt to assets and debt to capital is at healthy levels. They continue to return value to shareholders via dividend and buybacks. And they have amazing same property net income growth rate. I was extremely happy with the numbers that I see in this report, and I will continue to hold my shares in Granite REIT. There you are, guys. I hope you enjoyed the video. If you enjoyed the video and my coverage of earnings report of Canadian companies, consider subscribing to the channel to see similar videos. I will wait for my other Canadian companies earnings report to hopefully cover those as well. But until that time, I see you guys in the next video. Farewell.